In this week's video, we'll review the latest charts to help us answer the question, is the stock market bubble finally bursting? This is the S&P 500 as of Friday, December 17th at 11:53 a.m. Eastern Time. This chart is provided if you wanted to circle back and use it as a reference point. Similar situation here. And in terms of allowing you to update some of the charts that were covered during Thursday's session, during Friday's session, growth was beating value, tech was beating value, tech was beating energy, tech was beating financials, the market was beating energy, financials, and value. This portion of the video is being recorded on Friday afternoon. The S&P 500 was down around 19 points a little bit before 2 p.m. Eastern Time. None of the commentary that follows has to be adjusted in any way based on what's happening on Friday. These are two different views of credit spreads as of December 15th. Clients and regular viewers know this is the type of look here that we would like to avoid. This is a spike in fear during the COVID plunge in the stock market. Haven't really seen anything like that yet. Here's a zoomed in version here on the lower portion of your screen. If you've been trading the markets for several years, you probably remember this plunge in Q4 of 2018 in the S&P 500 that began. The market peaked here in late September of 2018, and the bottom came after this point here. It eventually came on Christmas Eve 2018. You may have heard some rumblings this week heading into the Fed meeting that we had a very, very similar setup to what we had in the December 2018 period. The Fed had a statement on December 19th, 2018, and this is what happened after the statement. This was the day before the statement, the day after the statement. Thus, heading into this week's statement, we were curious to know, this is what the chart looked like before the statement right here in December of 2018. How did the same chart look heading into this week's Fed statement? Better, worse, or about the same? The answer is quite a bit better. Heading into the Fed meeting in December of 2018, we were making basically a one-year low. We're up here at a point now where we're making basically a new all-time high. Heading into the meeting, looking very, very close to getting a full-bore bearish look here with blue, the fastest moving average on the bottom, price below all of the moving averages. Here, we have blue, the fastest moving average on top, and prices above all of the moving averages, and all of the moving averages are still up. This was the look a few hours before the Fed statement. This was 11:19 a.m. on December 15th, and this was the look after the Fed statement at the close on December 15th. So this is the close after the meeting on December 19th, 2018. This is the look after the meeting on December 15th, 2021. This really doesn't look anything like this. Markets have been very indecisive and volatile recently, so on Wednesday's session, the S&P 500 was up 75 points. Thursday's session, December 16th, was a different story. It was a mixed bag. Somewhat of a sector rotation day with a lot of red on the screen and a lot of green on the screen. Let's review a few examples and see if any relevant changes have occurred. So during the day on December 16th, value, significantly green over here, VTV, where my cursor is, quite a bit different, almost the polar opposite of the technology sector ETF XLK here, significantly red. And ultimately, what we would be concerned about on our time frame would be, do we want to start to overweight value relative to tech? And it's important that we differentiate between XLK tech and let's call it ARK tech. So this is ARKK, the ARK Innovation ETF relative to XLK, the tech sector ETF. You can see early in this year in 2021, ARKK started to underperform the tech sector significantly. And this downtrend is still in place, or was in place as of December 16th at 2:05 p.m. Why this chart is important, some tech, some segments of the market have been hit very, very hard, and others have held up relatively well. This tweet here and this graphic here from Alpha Charts helps tell the story. Some individual stocks and some ETFs here. Typically, your larger cap tech have held up pretty well. So your drawdowns up here for like QQQ are less than 10%. Not the case here for a lot of individual stocks or some other ETFs. Some of the drawdowns from their recent peaks significant. Here pushing 80%, some pushing 70, 60, 50%. Quite a bit different from QQQ and Apple and Cisco that are sitting up near all-time highs. So what's the biggest difference between ARKK and XLK that may have caused ARKK to significantly underperform XLK now for several months? Well, for the most part, it's market capitalization. XLK tends to be your large cap, more stable, established companies with stable revenues. So if we look at XLK, the portfolio, only about 6.45% of it has exposure to small caps and mid caps. That's quite a bit different from ARKK, the ARK Innovation ETF. Instead of 6%, it's 51%. So one way to look at this is small caps and mid caps were outperforming significantly in here, and then during the course of 2021 that shifted and large caps have been outperforming for the most part small caps and mid caps since Q1 of this year. Our exposure has been to the large cap space, so that's what we're going to focus on. Keeping in mind that large cap tech got whacked on Thursday of this week. So the question is, has the trend changed? How concerned should we be thus far? So let's take a look at XLK from the beginning of 2020 on the left side of your screen until early September here. When you have a strong trend, sometimes you can get this dislocation look here. This is the COVID plunge. So if we're seeing something similar to this is somewhat of your hot knife through butter look, that would be concerning. Here's some normal volatility here where you get consolidation near the 50-day moving average, some normal consolidation, and this was the look here heading into early September. This is a very, very strong trend look here. Another thing to keep in mind, when we fast forward to the right side of XLK in the present day out here, this is also the type of look that we would like to avoid. Somewhat of a wild swing, high volatility look where the market can't decide if it wants to stay above or below the moving averages. And this would be the morphing from an uptrend to the downtrend look that we would want to avoid. So this is the major peak in the S&P 500 in October of 2007. So full bore bullish look over here early in 2007, and we start to morph very, very close to a full bore bearish look over here. So we don't want to see anything like this on the chart of XLK, and we really don't want to see this type of hot knife through butter look. So if we fast forward from early September to intraday when tech was getting whacked on December 16th, very, very hard to make the argument that the chart in front of us really looks anything like this yet. Hard to make the argument that it even looks as concerning as it did back in September, November of last year. And we even look stronger than we did here in March, here in May. And we look quite a bit better right now than we did in September and October. Obviously, that's subject to change. But as always, our commentary is based on the chart in front of us. Under our approach, what we're asking every day is, are we allocated properly based on the facts that we have in hand today? As of Thursday's session around 219, nothing particularly alarming here yet. It's not making any prediction about what it's going to look like in the future. So if tech in isolation still looks good at this point, what about technology stocks XLK relative to value? Are we seeing a relative trend shift that's telling us we should be selling some tech at this point and moving it over to value hypothetically? Now we're looking at XLK relative to value, VTV, once again intraday. When tech was getting whacked relative to value, you can see it was dropping almost 4% over here in the upper right-hand corner of the screen. However, there's really not a lot of damage to the trend. Tech was winning over here in 2020, where my cursor is over here on the left side. Then we had a little bit of a retracement, kind of a scary give back in here, a big shift. And then what looks like a resumption of this uptrend here. So if we look at the low that was made in May relative to the peak up here, and we look at the give back that we had on December 16th, haven't even come back to the 38.2% retracement of this A to B move. Concerns about the tech trend relative to value would increase if you take out the 50% retracement, the 61.8, and come down below the moving averages. So basically, if we morph back into a look like this, especially after getting a bullish breakout, so we would have a bullish breakout and then a significant failed breakout look. If you plunge in this direction, take out this level here at point A, and then morph back into this, and all of that could happen in relatively short order with the setup that we have, something that we have to be ready for. That would be concerning. It's just not what we have at this point. We have something that says we better pay close attention, and we better respect the fact that typically a bullish breakout that fails is not a good thing. This could just be a retest at this point. Not unusual on a retest to go back below the breakout level, somewhat of a fake out look, and then push higher. Nothing particularly alarming here other than a pay attention or pay closer attention look. Then if we look at technology during Thursday's session at 2:45 p.m. Eastern Time, once again when tech was getting whacked relative to the market, it looks even better. Here's the bullish breakout here above the September high from last year in the ratio breakout, and this does look like a retest at this point. And if we take a step back, this breakout here that occurred in November and is still in place was after 15 months of consolidation in the blue box. And if you look at this here and you look at this tight cluster of moving averages and you look at price in here, and a really, really good reference point area of potential support in here. And once again, we would learn something. If we can't hold all of this and we get down here and move into here, the longer that we stay there, and frankly, the faster that we move there, the more concerning it would become. So you don't want to see a hot knife through butter look here where we give all of this back and then stay down here. That may happen, but it hasn't happened yet. What we have right now for tech versus the market is a bullish breakout that looks like it's still holding at this point. Price is still above all the moving averages, and blue the fastest moving averages on top. Haven't even taken out the 50-day moving average here in blue. We've seen this type of movement all year. The market's been flipping back and forth. It either likes tech and growth or it likes the value trades, which are traditionally financials, XLF, XLE, energy, XLI, industrials. So how about financials? This is XLF relative to SPY. Right now we're below all of the moving averages and the 50-day is rolling over. But this is more of an indecisive look here. The jury is somewhat still out. The longer-term trend is against XLF. The multi-month trend is even against XLF because this is a high, this is a lower high. Down here, we're not looking real strong at this point. But once again, that could move rapidly into this area here, and all of this would start to look more like this over here. But given this high and this lower high here, and when we look out further, there's really no question that financials are still in a long-term downtrend relative to the S&P 500. And even if we can get into this area here, there's still other hurdles to cross. Other side of the coin, this is a lot of consolidation here. If you can get out here with this ratio and hold that type of breakout, then the whole outlook changes. That may happen, but it just hasn't happened yet. Now let's take a look at energy that was up during Thursday's session. Take a look at the market, which was down, and tech down on Thursday's session. Very, very similar situation here to financials relative to the market. So this is XLE energy relative to the S&P 500 SPY. Good news, if you like energy, this is a long-term period of consolidation. The longer a market goes sideways, the bigger the move that you can expect to get. The bad news is our highest high here is in June. In March, we made a lower high, and then we made a lower high in June, and then we made a lower high relative to that high in October. You can take a chart like this and you can say this is maximum fear about inflation here. We almost get back up to that level in March of this year, because we all know if inflation is high and interest rates are rising, we would rather own energy than the market. Energy should be outperforming. So an argument can be made, highest inflation expectations, longer term expectations here, they're lower here, they're lower here, and they're even lower in October, and they're even lower now in December as of December 16th. The good news is, if you can get a breakout out of this consolidation period, you can make an argument this is a left shoulder, this is a head, and this is a right shoulder. The problem with that is you'd really prefer this to be the other way around. You would rather have this longer term period of indecisiveness over here in the left shoulder and this shorter term period of indecisiveness in the right shoulder. There's really not a lot of symmetry here. It looks that way here. If we would have broken out here, that would have been a nice symmetrical head and shoulders where the right shoulder was higher than the left shoulder. And in duration and time, it would have been either equal or shorter. That would have been perfect if we could have broken out here. We haven't done that. And this is a inverse head and shoulders pattern that really doesn't look like an inverse head and shoulders pattern anymore. However, if we can break out, that still would be very, very meaningful. That may happen. It may happen very, very soon, but it hasn't happened yet. All of these shifts here are typically tied to interest rate expectations, which is tied to inflation expectations, with the thought being high multiple technology. The multiples are going to come down if interest rates go up, and you're better off owning energy, financials, industrials, etc. Once again, all of it's tied to interest rate expectations and inflation expectations. And once again, if the market really believed that inflation was going to continue to push higher for a very long period of time and interest rates were going to go significantly higher, then this is what we would expect. We would expect tech to be underperforming energy. So if we look at energy relative to tech, the same situation here. It looks like concerns about inflation or confidence about the reopening peaked in June of 2020. So this ratio hasn't made a higher high in well over a year. June of 2020, a lower high in March, a lower high in May, June, and then an even lower high in October. So if we draw this trend line here, if market participants really thought energy was a better place to be, we haven't even been able to close out this white space here yet. The good news, if you like energy over tech, this cluster here tells us if we can get to the other side, this could move fast. So no question, this is indecisive here, kind of hanging around. We could get a move like this soon, and if we can break above this level here, then really all of the commentary in this week's video would shift, and that may happen again soon, but right now, this is the chart in front of us. Another thing that we would be looking for, the S&P 500 was down on Thursday, but this doesn't look like everybody's running for the exits. Everybody's running for the exits would be basically red all over the screen, maybe with the exception of bonds and defensive assets tied to precious metals. It's not what we have. This looks like healthy rotation during Thursday's session related to topics such as interest rates and inflation expectations. So given these wild swings, now let's look at the market and see if anything significant has happened there. Early September, you can see we have a very strong, this is a rare look here. It's very rare that you get a look like this strong for this many months back to back. And if something's going to happen in short order, it would probably be more like this hot knife through butter situation relative to a multi-month rollover situation like we have here at the major peak in 2007. And there are reasons to be concerned here, and we've covered them in recent videos. Breadth has been concerning. We've had high volume sell-offs in ETFs. We've had signs of institutional selling or distribution. So it is possible we should be on watch for something like this over here on the left side of the screen. So if we fast forward to Thursday's session, December 16th at 3:13 p.m. Eastern Time, how bad does this chart look today? Does it look like this? Does it look like this, or this? It's very, very difficult to get overly concerned about the stock market's trend when the S&P 500 is well above an upward sloping 50-day moving average at this point. And the recent low that we had in December, thus far, the low in December is significantly higher relative to the low in October. This is intraday when the S&P 500 was down 54 points. As we've mentioned numerous times in past videos, we could have made similar "things don't look that bad" statements here. There's nothing wrong with that. We're making comments and commentary and decisions based on the chart in front of us. When something like this happens, you have to be willing to adjust very, very quickly if needed. And we do have enough concerning evidence in hand today to tell us we should be open to something like this happening. So far, this still looks very, very good. One of the big fears here is that long-term interest rates are going to rise. So let's look at interest rates directly. And once again, if the market really felt like inflation was going to be out of control for the next 5 years and was just going to continue to go up, it really doesn't make a lot of sense that 10-year yields are lower today than they were back in March of this year. This lower high here means that demand for 10-year treasuries has been, for the most part, stronger since March. This is what increasing inflation fears looks like over here when yields are rising. We've been consolidating here, and we really haven't even made a serious push to overtake this high yet. Like many of the charts we're looking at, this could change, but this downward sloping line here, you can still make an argument it speaks to decreasing inflation expectations. Somewhat similar to this downward sloping line here. And if we put a 50-day moving average on this chart, price is below what looks like a 50-day that's trying to roll back over. And the type of trade that we saw during December 16th session is tied to an expectation, for the most part, that the trend in interest rates is about to shift. It's hard to make that argument here because interest rates, longer-term rates, are for the most part defined by the 10-year yield. Yeah, shorter-term yields have moved, but eventually if interest rates are going to go much, much higher, it will impact the 10-year yield, and right now this is somewhat muted. And if we take a big step back, the 10-year yield is significantly lower today than it was in 2018, and the long-term trend, despite the commentary that we hear every day, is unquestionably, unequivocally down. And a lot of things have to happen here before that changes. As always, we're not making any assumptions about what this chart will look like tomorrow. It is possible that it could move up here in short order. But we know with 100% certainty what it looks like today. And what it looks like today is a very long-term, established, and still in place downtrend in interest rates. You can pause your video player here. This is an indicator that sums up total market declines. So think daily declining issues on the American Stock Exchange, the NASDAQ, and the NYSE. We've plotted it on a weekly chart just to make it a little bit simpler. This is not a good thing. This tells you that declining issues was very, very rare and very, very high in a recent session. You can see this is data going back all the way to 1991. It's very rare to get up to this blue line here where we were in late November of this year. So we wanted to know, if you have such a lopsided sell-off where decliners are just a very, very rare and large number, and you're still within the context of a strong uptrend, and the way we define that was, how many times has this happened while you were above the 50-day moving average on the S&P 500? The answer? 4 times going back to 1991. This is S&P 500 performance walking forward. So these are the cases where we hit the blue line similar to what happened in November of this year, and the S&P 500 was still above its 50-day moving average. There's a lot of yellow and red here, but this is like a lot of studies that we performed in recent weeks. It's binary. This case looks really, really bad. This is near a major peak in 2007. This case is almost the polar opposite. In this case, 2 years later, you're down almost 30%. In this case, you're up 66% plus. It's not really giving you an advantage here. If you err to the bearish side and you're wrong, you could be really wrong. If you err to the bullish side and you're wrong, you could be really wrong. We performed a lot of studies like this. We haven't shared them because a 50-50 outlook is a coin flip. It's not particularly helpful. How this is helpful, though, this is a rare occurrence here, and typically when something rare happens, you want to pay closer attention. How about market drawdowns in these cases that are similar to the present day? We looked at the 35 calendar day drawdown because that hypothetically would take us to year end in the present day. Average and median relatively muted, but really all over the place. Almost no drawdown here, almost no drawdown here, and fairly big drawdowns here. Really not that helpful. Similar situation looking out 7 months. Almost no drawdown, almost no drawdown, medium-sized drawdown, and a very large drawdown. In the short run, half of these cases you would do nothing. Half of these cases, it depends really what your time frame is. But in the short run, it might be helpful to look at this. If this is the 1996 case, and between now and year end, in that case, we would hypothetically get a very muted drawdown. And in the 2007 case, we would get a much larger drawdown here. If we put these four on a chart, it may help us a little bit with probabilities. If the market can hold between now and year end above this October low, that would be a good thing in the short run. If you break that October low, then the probability of us morphing into something like this starts to increase a little bit. So this data here and these looks here, they back up the concept of trade the chart in front of you. If this chart starts to deteriorate in a meaningful way, that could be concerning. Right now, it just hasn't happened yet. This was the 35-day calendar day drawdown, and this is the 7-month look here, so that hypothetically would take you to June 24th of 2022. Once again, binary cases, almost nothing here, not too bad here. This one's fairly significant. You can pause your video player here. A tweet from Ryan Dietrich. Here's his Twitter handle. This comes from LPL Financial. The week ending Friday, December 10th, S&P 500 gained 3.8%. What this tells you is typically during the present day bull market, when you get a big weekly gain, good things tend to happen looking out 1 month, 2 months, and 3 months. 3 months later, 92% of the cases were positive and the average gain was 7%. Worst case scenario was 2011, you lost 15%. We wanted to know, using these dates identified by LPL, how did the market perform over the next 21 calendar days that would hypothetically take us to year end? That's this column here. And then how did we look on a 6-month, 9-month, 1-year, and 2-year outlook? In the cases shown in the tweet, these were your signal dates here. 1 year later, the average gain was 23%. All of the cases were higher. 2 years later, the average gain was 36%. All of the cases were higher. How about the maximum 21-day drawdown in these cases, giving us some idea of what it might look like between now and year end? Like many of the studies we've done recently, a mixed bag. The average and the median drawdown here, 2.67, a little less than 2%. That would take us from the date of the signal, which was last Friday, December 10th, down to the area where we are now, roughly. But we do have some big drawdowns here. So once again, really not particularly helpful, a mixed bag, and it says trade the chart in front of you. Let's talk a little bit about asset class behavior in the present day. This is the S&P 500 relative to long-term treasuries. A lot of takeaways here. This is the 200-day moving average in red. This is the 50-day moving average in blue. Notice here, we make a peak. We're back to that Q4 of 2018. This is your ruin the Christmas plunge in the S&P 500 here on Christmas Eve. But when we get to the COVID plunge here, this ratio hasn't made a higher high in well over a year. And look what happens here between point A and point B before the COVID plunge. A lot of confusion. The ratio goes above and below a 200-day moving average. The slope of the 200-day is down here in red, and when we slice through it, it's flattish, and then it almost immediately rolls over. Sign of a weak, longer-term trend. And notice the amplitude here in the swings in the 50-day moving average. Prices touch the 200-day between point A and point B several times. Prices oscillated above and below the moving averages several times. How does that compare to where we are today in terms of conviction? This is a low conviction look here, a downward sloping trend line favoring long-term treasuries over the stock market. We really don't have any of those things today. If we look backwards here, for the most part, prices stayed above an upward sloping 50-day in here and at 200. Starting to change a little bit, though, as we're now oscillating up and down above the 50, but we've only touched the 200-day one time thus far, and this trend line here shows a series of higher lows and higher highs. We just made a new all-time high in this ratio just a few weeks ago. Contrast that with here. You're talking again over a year. So your risk-reward ratio here is much, much lower than it is here. Now, that doesn't mean we're not going to move into this area here. We very well may do that. But right now, the last thing that's happened here is we had a bullish breakout, a new all-time high. We really haven't made a significant lower low yet. We would have to undercut this September low here. We still have this multiple month period of consolidation, which is bounded by this dotted line and this dotted line. And right now, we're above both of those lines. All of this is just potential support. Concerns would increase. If the ratio gets down into this area, the longer it stays there, the more concerned we would become. This is the look of it as of the close on December 16th. In fact, we closed on December 16th above the 50-day moving average. The data delivered a mixed message here. This was December 3rd, and again on December 10th. There were some good things to talk about, and there were some concerning things to talk about. Again, on December 3rd, one of the negative bullet points was volume and/or breadth. We've performed a lot of breadth studies in-house in recent weeks, and they have been somewhat mixed. Here's a sound study that we were asked about earlier this week. From this tweet earlier this week, last week's new high on the S&P 500 was accompanied by more new lows than new highs on the NYSE. It's basically a form of a breadth divergence. And here are the cases here, and the summary was, in the past, the market hasn't tended to celebrate this sort of divergence. And that's an accurate assessment here. Typically, in all cases, when the S&P 500 makes a new all-time high, a year later, it's higher by about 9.4% here. In these cases, quite a bit lower, 5.7%. And if you look at the same type of analysis, looking out 4 weeks, 8 weeks, 13 weeks, and 26 weeks, there's no question that the cases shown here produce less favorable returns relative to your typical situation where the S&P 500 makes a new high. So the median outcome here tells us that we should pay closer attention and we should keep an open mind about worse than expected outcomes. If we look out 1 year, so these numbers here on the right side of the screen, if we walk forward from these dates here a year later, 5 of the cases the S&P 500 was lower. The average loss was 7.78% in those 5 cases. The median loss was 8.2%. And these 5 cases represented roughly 38% of the cases over here. So said another way, there's a 38% chance that you're going to lose somewhere around 8% after something like this happens. That's not great, but there's a 72% chance that a year later your return might be as good as 10 to 12%. That's not too bad. In 13 of the cases, the stock market was higher a year later, and some of these returns are quite favorable here. So the moral of the story is this too is mixed. This is somewhat binary. If we get a case like this, this, or this, well then it is concerning. But if we get a case like this, or this, or this, or this, or this, or this, it's not particularly concerning. So how is it helpful? Well, it's helpful that it tells you these aren't all favorable. Helps you keep an open mind about worse than expected outcomes. Helps with maximum flexibility because really good things could happen or really bad things could happen looking out a year. Let's take a closer look at these cases. These are the worst 3 cases 1 year later. All of them, the signal comes from December of 1999, December 3rd, December 24th, year-end 1999. Thus, it might be helpful to compare December of 1999 to the present day. So these are the same moving averages we've been looking at in a lot of the videos. This is the 50-day in blue all the way out to the 250-day silver here where my cursor is moving around. You can see this is December here of 1999. So walking forward, if the present-day S&P is wacky volatile like this and price starts to move up and down above the moving averages, our concerns would increase. And obviously, if we get a rollover look like this, where we start at full-bore bullish and end up at full-bore bearish, our concerns would increase. So the study's helpful. It gives us a roadmap for the 1999-2000 case, some things that we can look out for in the months ahead. Also noteworthy, the cases that started in December of 1999, the stock market really doesn't peak and start to have a major problem until September of the next year. This is the highest peak here, but you can see the 50-day moving average peaks here, and the trend really rolls over in earnest in September of 2000. So how does the same chart look today? Are we getting wild swings like this? Are we getting a 50-day that's going up and down? We don't have it yet. This is December 16th. So if this chart morphs into something like this, then our concerns about something like this, or this would increase. That's helpful. So if we want to take somewhat of a fair and balanced approach, we're looking at the three worst cases here. Now, let's shift to the other end of the spectrum and look at the best case scenario. The best case scenario, something similar happened on March 10th of 1995. Ms. Fair asked, does the present day look more like December of 1999, or does it look more like March of 1995? And March of 1995 is here. We already know that this period here on the left side of your screen really doesn't look like December 16th of 2021, at least not yet. Now, how does the present day compare to this period in here? So walking forward from where my cursor is here, does the present day look more like the right side of the screen or the left side of the screen? Notice price here, for the most part, staying above the moving averages. We have nice clean separation. This is a strong trend look. This in here really doesn't look anything like this mess here. I think it's fair to say the present day chart on December 16th has that very rare strong trend look here, and that's very, very similar here in 1995 and early 1996 to what we have in recent months. That doesn't predict anything. This chart here could very well morph into something like this. Volatility has picked up. There's no question about that. But another thing to keep in mind here, so this strong move here where the moving averages turn up, you can make an argument it's similar to this period in here. And notice, the longer this went on in 1995, eventually volatility did pick up in here. I think you can make an argument that this boxed area here in the present day, so this would be December 16th, this point right here, you can make an argument it's similar to this point here. And here what happened was you undercut this low back here, and you went almost all the way back to the upward sloping 250-day moving average. But notice, the longer term moving averages for the most part kept that strong trend look during this really plunge here. This is a relatively large drop where my cursor's moving around. If we saw something similar hypothetically in the present day, for the most part, you'd undercut this low in October, and you'd come back somewhere in the neighborhood of 4,300. You'd do it relatively quickly. Maybe your 50-day would even weaken a little bit in here. But what you'd really be looking for is, do you, for the most part, maintain that strong look, and do you hold, for the most part, the lower moving averages? This is not a hot knife through butter look because you eventually hold and pop back. This look here, quite a bit different from this look here where you just really disregard the trend in the rearview mirror and just say, sorry, that was a big mistake. So we have somewhat of a roadmap for this type of scenario. We don't want the chart in the present day to morph into something like this. And we have somewhat of a roadmap of this type of scenario where the trend stays strong, but you might have increasing volatility. And that might look like a pullback into these moving averages, but for the most part, you would expect these moving averages to bound price somewhere in here, or if we overshoot, that we wouldn't stay down there very long, and that we would pop back up relatively soon like this. See how you consolidate here for a while, You don't really run away from the moving average cluster. The same thing would be said if you consolidated down here for a little while. But you don't want to stay down here too long, and you want to pop right back up. Not a prediction, one of many possible outcomes, including this type of outcome. It's good to have a roadmap for both extremes. There's no possible way the present day will be identical to either case. It might be similar, and that knowledge might help us manage risk. How is it possible that something like this could happen where this strong trend look for the most part holds in here? Here's a headline from the Wall Street Journal this week about millennials. You can pause your video player. That's that demographic topic that we've talked about numerous times. Here's a tweet on the left side that ties into this article. Given the look of the charts during the session on Friday, December 17th, it's very difficult to say that the NASDAQ 100 currently has a look of a market that's rolling over or making a major peak. A 50-day moving average really isn't all that relevant to our time frame. Having said that, during the session on Friday, December 17th, the NASDAQ 100 was still trading above an upward sloping 50-day and well above an upward sloping 200-day. The same can be said for the S&P 500. December 17th, this chart was printed around 1:35 p.m. Eastern Time. And as we all know, the only way that any of this works, especially if we're going to identify a shift in the market's trend walking forward, is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.